VICI Properties is down nearly 8% over the last year. It is also heading towards that 52-week low that we have seen not too long ago. It is a company that I hold in my own portfolio, and in today's episode, I'm going to be running through my own strategy for VICI Properties, whether or not I believe it to be a buy now and exactly at what price I will be looking to add shares. We will be taking a look at the historical performance of the company, as well as deep diving into their income statements, looking at their revenue growth year on year, as well as that all important bottom line, that net income of the company. We're also going to jump into the balance sheet, take a look at their health, and in particular their total cash versus their total debt. This in turn is going to lead us into that all important dividend safety and some very important financial metrics you need to understand as investors or potential investors of VICI Properties. And as always, we are going to run it through our stock valuation model, getting to our intrinsic value and finding out our acceptable buy price given that all important investor margin of safety. Now it is down 7.6% over the last year. As we can see, it is towards the mid to lower end of the 52-week range, and it does offer a very nice forward yield of 5.36%. So in today's episode, we want to understand, is this an undervalued price? Can we lock in this very nice starting yield, which over the next few years, can we see some strong growth on both the share price as well as that yield on cost, seeing some low double digits, 10-11% yields on cost. Now, shareholders who have been holding the company over essentially the last 5 years, you would have seen growth at around 44%. Now, it's not something you really want in a company, an investment, 44% over 5 years. Granted, it doesn't include that dividends reinvested, but the point of today's episode is not to look back at historical prices, but forwards and see, is there somewhere where we can find good, strong growth in this company? Now, in terms of the income statements year on year for REITs, what we typically like to see is 5 to 10% growth on the top line. December 2018, around 898 million on the top line. December 2022, latest annual report, around 2.6, 2.7 billion. So very strong growth on that top line is positive to see. And what we can see on a more granular level, they did have a slight drop on the top line in 2018 to 2019. However, from that point on, it did pick up some strong, consistent growth. And shortly, we're going to take a look at the last 10 years in percentage terms. Now, in terms of the bottom line, how does that follow? Well, December 2018, 524 million on the bottom line. Roughly double that 5 years later, December 2022, 1.1 billion. So again, very positive to see growth on the top line and bottom line. And again, on a more granular level, we can see that consistent growth year on year. So again, very positive to see so far on the income statement. Now, very briefly, a quick health check on the balance sheet, total cash versus total debt. With the cash, what we see in December 2018, 578 million. Latest quarterly report, around 739 million. So they have been increasing their cash balance, although fairly small over the last 5 years. And in terms of the total debt, how does that compare? Well, we can see around 4.1 billion in December 2018 and a huge increase in the latest quarterly report, around 17.5 billion. Now, typical companies, this might surprise us. However, with REITs, this is fairly typical when we take a look at their total debt over the last 5 years, and we'll explain shortly why. Now, in terms of the dividend safety score, we have a score of 50, making it borderline safe. It does have a market cap of around 31 billion, making it a large cap company. Now, typically with companies, we look at key metrics in terms of recession data to see what we'd expect potentially from an upcoming recession. However, given the company data isn't available and the company wasn't founded in this period, this will essentially not be applicable. So moving firstly into the dividend growth, some very positive news for shareholders of the company. There was a recent, in fact this month, a dividend increase of 6.4%. And what's positive to see is that dividend growth over the last 4 years, consistent increases on the dividends, and we will touch upon that in terms of the numeric values when we take a look at our dividend discount model. Now, in terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. Currently, what we see 5.36 versus 5.03. So you could personally argue it is borderline undervalued / reasonably valued. However, as always, we never look at any model in isolation and we'll draw our conclusions towards the end of the episode. Likewise, forward P to AFFO ratio is fairly in line with that 5-year average, 14.2 versus 14.8. Sector P to AFFO slightly lower at 13.3 versus 14.2. And as I mentioned, it is towards the mid to lower end of that 52-week low. However, I always say, and it's very important to understand, 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, typically viewers of the channel know we tend to ignore the earnings payout ratio that we see for the typical companies, focusing on the free cash flow as earnings is susceptible to manipulation by management. However, with REITs, we tend to ignore the free cash flow payouts purely as it can be slightly more volatile due to issues such as upfront rent payments, maintenance expenses, and deferred financing costs. So we typically tend to look at adjusted FFO, funds from operations. What do we like? Around 75% is the sweet spot for these type of hotel REITs. And what we can see consistently over the last 5 years, it is around that 70 to 80%, with 75 again being our sweet spot. 2023 is expected to be 76, so in terms of dividend safety, based on this information alone, it looks to be okay. Now, adjusted funds from operations, again, this is what we'll typically look at as opposed to the free cash flow per share. 37 cents in 2017, $1.93 in 2022. There was that rapid growth in 17-18, but from then there has been nice consistent growth, with 2023 expected to be 2.18, so again, very positive. Now, sales growth, I did mention 5 to 10% is what we typically like to see. Quite strong growth in 2017 to 2018. Some flat growth in 2019, again, you could argue, due to COVID, the lockdown. And then it has picked up again, nice strong double digits. So it would be interesting to see 23 full year data if we do see again some strong double digit growth. And numerically speaking, it has gone from 200 million sales in 2017 to 2.66 billion. So very, very positive, very strong growth. And this is one of those companies that I believe can outperform the rest in your portfolio over the long term. Now, shares outstanding, typically we love it when the graph goes downwards. As shareholders, we love it when companies do share buybacks, returning excess cash to our pockets. With REITs, however, it is typically the opposite. So this is normal to see. What essentially is happening is they are issuing equity to fund property acquisitions, as they do retain minimal generated cash flow after paying dividends. As we saw, the payout was around 75%. So what we see here is around 228 million shares outstanding in 2017, 880 in 2022. Again, this is something we typically see with REITs. Now, ROIC, one of my 7 golden dividend metrics. Check the pinned YouTube video to see the other 6. I love to see 10% plus. Why 10%? Because it gives me faith that management are able to effectively allocate their capital. However, for REITs, it's typically between 3 to 5%. A company like Realty Income, which I have also reviewed recently, is around 4%, just as a benchmark so you can know. So fairly positive to see between 5 to 8% over the last few years. If they keep this up, very positive in my opinion. Operating margins, again, very, very strong. If we can see, it's above 63% over the last 6 years. So again, a big positive. If they continue this, this will really help that bottom line, that net income, and will help signify a further greater dividend safety score than what we see currently. Now, in terms of the final metric, which is probably why we see this dividend score safety at 50 rather than 70, 80 that we prefer to see with Realty Income, again, for those that want to know, as a benchmark sitting at 80. Well, this is one of the reasons. So this is the net debt to earnings before interest, tax, depreciation, amortization. The company does hold a lot of debt. What do we like to see? Around 3.5, signaling the number of years it would take the company to pay off all of their debt net of cash on hand. Realistically, it hasn't really been below that for many years. We see 2022 at 6.46, which is significantly higher than what we like to see. However, 2023 is expected to come down to 5.67, and I would like to see the next few years come even further down to around that 3.5 and help solidify a stronger dividend safety score. One of the reasons the company takes on a lot of debt is to fund other property acquisitions for the company going forwards. And that helps essentially the top line, the revenue. Now, on the right, we're just showing the percentage of the company's financing from debt as opposed to equity, sitting at around 39% in 2022. As always, if you do enjoy the content, smash that like button, hit that subscribe button and the bell button to have these videos delivered directly to your doorstep as they are dropped on the channel. And as always, if you want to run your own company through the stock valuation model, getting to your own intrinsic value based on your own portfolio of companies, do grab a copy in the pinned description below. Now, starting with VICI's Graham's valuation. So Graham's valuation is what we typically use for other companies. For REITs, it isn't appropriate, so we won't be using it or including it in our intrinsic value calculator. However, for those that are new to the channel and want to understand how it works, very quickly, we have the stock ticker VICI, earnings per share at 224, growth rate per analyst estimates at 9, with that yield on AAA corporate bonds at 5.08. This gives a Graham's valuation model for VICI at $31. As I mentioned, it isn't appropriate for REITs and therefore we are excluding this from our model. So the first model we're using is the REIT multiple valuation model. We have companies in a similar sector and size, SBA Communications, Digital Realty Trust and Extra Space Storage. We have their stock price, P to AFFO multiple, getting an average P to AFFO multiple of 17.86, dividing by the P to AFFO of VICI and times by the current price, gives a REIT multiples valuation model price of $38. Now, when we take a quick look at the current trading price, that's showing some very strong, nearly 30% upside to the current trading price and above that 52-week high that we have seen not too long ago, signaling some nice upside to the current trading price. We then move on to the dividend discount model. As we can see, very nice increases over time over the last 4 years in our specified period. Average growth at 9%, so that's very, very strong, very good to see as an investor. It is above that 4% I always say to get above, as that is the US inflation rate at 4% over the last 40 years. So anything essentially below 4% in your dividends, other income producing assets, or salary, you are taking a pay cut and losing purchasing power. So do aim for 4% as a minimum just to be in line with inflation. So I have gone as a more conservative 4% in line with inflation, forward looking for the discount rates. As always, if you do want to justify a higher or lower growth rate, you can grab a copy of the model and get your own DDM price as well as other prices for the intrinsic value calculator. However, based on the estimates and judgments we've run through today and the 4%, this gives a DDM of 43.64 cents, again signaling some strong upside to the current trading price and well above that 52-week high. We then move on to the third and final model for VICI, the DCF model, the discounted cash flow, where we have the free cash flows year on year. Average growth rate very high at 95%. Forward looking, analysts estimating between 12 to 14%. So I have gone slightly more conservative. With our discount rate, we get the present value of these future free cash flows and terminal value. Add that with the cash, subtract total debt, and we arrive at the equity value. Divide that by the shares outstanding, giving a DCF price of $42. Again, signaling some strong upside to the current trading price and well above that 52-week high, showing again signs of undervaluation. As always, if you are enjoying the content, smash that like button, hit that subscribe and join this wonderful community. And if you do want to grab this copy, do check the pinned comments below. So the intrinsic value comes to $41, the average of these models we've run through, again signaling some very nice upside to the current trading price and showing signs of going further than that 52-week high seen not too long ago. Current price is around $30.68. Now typically margin of safety, I'd say around 10%, wide moat, good forward-looking data, and strong financial metrics. However, for VICI and REITs, you could argue with the increasing in interest rates, which will hurt companies, to go for a much higher margin of safety. 20% margin of safety, again $32.94. And if you wanted to go even higher at 25%, your acceptable buy price would be roughly in line with the current trading price. Now, personally, I have added these shares into my portfolio, so I do hold VICI. However, it isn't the biggest position. I do want to increase it over time. So personally, around these prices of $30 and below, I am going to be adding more to the portfolio. As always, let me know your thoughts in the comments below. Are you looking to add VICI, sell VICI, or purely on the sideline speculating? And finally, Wall Street do forecast some nice upside to the current trading price, around $37 over the next 12 months. As always, let me know your thoughts in the comments. Don't forget to like, subscribe. If you want to grab a copy of the model, check the pinned comments below and grab a copy. And have a great day and catch you on the next episode.